You've spent your entire career saving for retirement, putting money away into RRSPs, building investments, and doing everything by the book. But what if I told you that the biggest tax bill of your life could arrive after you stop working? Because here's the truth. Most Canadians don't realize that retirement can push them into higher tax brackets, trigger OAS clawbacks, and cause double taxation on income they thought was safe. And it often happens at the exact moment they thought they'd finally be free from the CRA. I call this the post-retirement tax shock, and it blindsides thousands of retirees each and every single year. The good news? It's completely avoidable if you plan ahead. Hi, I'm Danny Perros, Senior Investment Advisor at CG Wealth Management. If you're approaching retirement or already retired, this video could save you thousands in unnecessary taxes. Because the way you draw income in retirement matters just as much as how you saved it. I've seen clients with well over $1 million in savings still end up paying more tax in retirement than they did while working, all because of poor withdrawal timing, uncoordinated accounts, and missed planning windows. So today we're breaking down the post-retirement shock most Canadians never see coming. What causes it, how to recognize it, and how to avoid it before it's too late. If you find this valuable, don't forget to like, comment, and subscribe. A lot of you are watching, not enough are subscribing. Now let's get into it. Number one, the tax system doesn't retire when you do. Most Canadians assume that taxes go down in retirement. After all, you're no longer earning a full-time salary, right? But the reality is often the opposite. In retirement, your income can come from multiple sources. RRIF withdrawals, CPP and OAS benefits, investment income from non-registered accounts, company pensions or annuities, rental or part-time business income. And when you add all of these together, they can easily push you into the higher marginal tax bracket than you expect. And because many of these income sources are taxable at different rates, the result is often a messy, inefficient tax picture, one that the CRA quietly benefits from every single year. So while your paycheck stops, your tax bill doesn't. In fact, what I've seen is that it can increase if you're not strategic. Number two, the RRSP to RRIF trap. For many Canadians, RRSPs are the backbone of their retirement plan. But here's the problem. RRSPs are fully taxable when you take the money out. By age 71, the CRA forces you to convert your RRSPs into RRIFs and start making minimum withdrawal payments, which attract taxes. If you've built up a large RRSP, say $800,000 to $1.2 million, those mandatory withdrawals can suddenly add tens of thousands of taxable income each and every year, whether you need it or not, and whether you like it or not. That can trigger a few things: higher federal and provincial tax brackets, old age security clawbacks once your income exceeds roughly $90,000, loss of income-tested benefits, and accelerated depletion of your registered savings. One client of mine had done everything right, saved diligently, stayed invested, retired debt-free. But by 72, his forced RRIF income pushed him into a 43% combined tax bracket and clawed back nearly 30% of his OAS. The problem wasn't how much he saved, it was how he withdrew it. Number three, the middle tax window most people ignore. Between the ages of 60 and 71 lies one of the most overlooked planning opportunities in Canada, what I call the middle tax window. It's the period after you stop earning full-time income, but before you're forced to convert to your RRSP. This window is golden because you can do many things. Number one, strategically draw down RRSPs at lower tax rates. Defer your CPP and OAS to reduce future clawbacks. Smooth out taxable income over multiple years instead of facing a big spike later. Let's look at an example. Let's say you retire at 62 with $1 million in your RRSP and a modest non-registered savings account. If you draw $50,000 to $60,000 a year from your RRSP between 62 and age 70, you can reduce that RRSP balance before it turns into a taxable RRIF and keep your future OAS intact. By planning these withdrawals early, you're not paying more tax, you're paying it strategically. And that difference can mean hundreds of thousands in lifetime tax savings. Let's look at number four, the OAS clawback surprise. For many retirees, the old age security benefit feels like a guaranteed safety net, but it comes with a catch. Once your taxable income crosses a certain threshold, approximately $90,000 in 2025, the government starts clawing back 15 cents on every dollar. That means for every $1,000 above the limit, you'll lose $150 of your old age security, on top of paying regular income tax. This is where many affluent Canadians get caught off guard. Their investment income RRIF withdrawals, or even a one-time capital gain can unexpectedly push them into clawback territory. And once that happens, it's too late to reverse it for that year. The key is to coordinate your income sources, balancing your withdrawals between RRSPs and TFSAs and non-registered assets so you can control your taxable income and avoid unnecessary clawbacks. Number 5, the hidden tax on the surviving spouse. One of the most painful surprises happens not during retirement, but after one spouse passes away. When both spouses are alive, income can often be split for tax purposes, keeping them in lower tax brackets. But once one spouse passes, that ability is lost, and the survivor can suddenly face a much higher tax rate on the same total income. For example, a couple drawing a combined $120,000 may pay modest tax while alive, but after one passes, the survivor could be taxed as if they earned the entire $120,000 of income alone, bumping them into a much higher tax bracket and accelerating RRIF depletion. This is often called the widow's tax trap. Proper planning, including spousal rollovers, strategic withdrawals, and life insurance based on tax offsets, can help mitigate this, but it must be addressed before it happens. Number 6, the end-of-life tax explosion. The final stage, the post-retirement tax shock, comes when your estate is settled. That's right. When the last surviving spouse passes, any remaining RSP or RRIF balance is fully taxed as income, all in that 1 year. So if you still have $800,000 in your RRIF, your estate could lose up to 50% of that value to taxes. It's one of the largest and most preventable tax hits Canadians face today. This is why many affluent retirees use RSP meltdown strategies, corporate-owned insurance, or charitable giving to offset this impact, ensuring that wealth transfers efficiently to the next generation instead of the CRA. The point isn't to avoid taxes entirely. It's to make sure they're paid on your terms, not the government's. Number 7, how to avoid the shock. Starting now, avoiding the post-retirement tax shock isn't about reacting. It's about preparing. And here's how you can start. First, build a multi-account withdrawal plan. Coordinate RSPs, TFSAs, and non-registered accounts to control the taxable income year by year. Also, plan RSPs withdrawals early. Use the middle tax window to reduce forced withdrawals. 3, stagger your CPP and OAS sometimes. Deferring the benefits can create long-term tax efficiency. Number 4, leverage your TFSA strategically. Withdraw from it during high income years to minimize your tax exposure. Number 5, stress test your plan annually. Review income projections, clawback risks, and legacy implications well before they become large issues. When your retirement income is structured properly, you'll not only keep more of your wealth, you'll also enjoy the confidence that comes with knowing exactly how your income flows year after year. The post-retirement tax shock catches thousands of Canadians off guard, not because they didn't plan, but because they only planned for accumulation, not distribution. But the reality is, the way you withdraw money in retirement can matter more than how you invested it. When structured properly, your income can stay predictable, your taxes manageable, and your benefits intact, allowing you to enjoy retirement without the fear of CRA taking more than its fair share. If you want a second opinion on your withdrawal strategy, book a time with me using the link in the description below. Because as you know, money never sleeps.